Good evening and welcome to Network Chicago. I'm Phil Ponce. Coming up on Chicago Tonight, disturbing economic trends. The economy shrinks by its biggest margin in a decade and consumer confidence takes a nosedive. What's the prognosis and what adjustments should individuals make in how they handle their money? But first, some local news. The City Council is trying to rein in dangerous dogs. Aldermen unanimously passed an ordinance today that targets dog owners. They could face fines of up to $10,000 and jail time if their dog seriously hurt or kills someone while running loose. There's also a $300 fine for letting a dog escape from a yard. A poll published today shows almost 40% of voters still don't know who they'll vote for in the crowded Democratic primary for governor. That's according to a survey by the Tribune and WGN-TV. It shows former State Attorney General Roland Burris leading with 25%. He's followed by former Chicago Public Schools Chief Paul Vallis with 13, U.S. Representative Rod Blagojevich with 11, former State Treasurer Patrick Quinn with 9, and former State Comptroller Michael McCollis with 4%. Among Republicans, Attorney General Jim Ryan leads with 51%. He's followed by Lieutenant Governor Corinne Wood with 16% and State Senator Patrick O'Malley with 9%. And finally, this year's Haunted Village in Daley Plaza has drawn a record crowd. Here's a sampling.
The city of big shoulders. I like it.
More than 250,000 people have visited the Haunted Village since it opened on October 12th. It closed tonight. And in case you haven't heard, there's a full moon this Halloween for the first time in 46 years. And it's a blue moon at that. That is the second full moon of the month. Those are some of the stories making news. Coming up, the length of the economic slowdown and personal strategies to ride it out.
This evening's uninterrupted presentation of Chicago Tonight is made possible in part by LaSalle Bank.
Today we'll be discussing the retirement funding ramifications of allocating a percentage of investment dollars to emerging market funds versus the relative safety of a more conservative index fund. Joining me is Patrick Palmer, professor of economics, whose theory regarding the relationship of international capital flows to the risk tolerance.
If money management isn't a passion for you, that's okay. It is for us. LaSalle, the bank that works.
This is Chicago Tonight, Wednesday, October 31st, 2001.
Are there new rules for the economy and how to handle your money? Good evening and welcome to Chicago Tonight. I'm Phil Ponce. It's now official. The longest period of economic growth is over. That's according to statistics released today. More on that in just a minute. And this comes after a big drop in consumer confidence. That's especially troubling because it was consumer spending that had been doing so much to keep the economy going. In normal times, there are ways to analyze when the economy might kick in again and when consumer confidence might go back up. And in normal times, there are some personal financial strategies that can help a person ride things out until they get better. But after September 11th, have the rules changed for the economy, consumers, and investors? And if they haven't changed completely, are there still some steps you can take to weather things a little better? We'll hear from our guests, but first to Elizabeth Brackett.
More bad news for the battered economy. A 0.4% drop in the gross domestic product, the biggest drop since 1991, when the country was in the depths of a recession.
People are having tough times in America. People are losing their jobs, and I'm deeply concerned about that, and I know you are as well. Consumer confidence is down. After all, we're at war. And for the first time in our nation's history, part of the battlefront is here at home.
Jean Meyer is one of those who has lost a job. Single and now living at home, she was laid off last March from her high-profile management consulting position with a multinational conglomerate that provided consultants to energy companies. With an MBA from the University of Chicago and 12 years of executive experience, Meyer didn't think she would have much trouble landing a new position.
I thought that something would happen by Labor Day. I thought things were slow. A couple of months after I was laid off, the first sort of big market correction started happening, and at that point some other friends and I who were in the same position decided that Labor Day would probably be realistic, and Labor Day has come and gone.
John Challenger heads the outplacement firm Challenger Gray and Christmas. He says it is taking longer for people to find a new job, as the job market has gotten steadily worse.
It started in manufacturing industrial about third quarter of 2000. It moved into the high-tech sector in January. Now, given the attack, the travel sector, airlines, hospitality has been hit very hard. Retail is likely coming. This season doesn't look as strong, and as we get late into the fourth quarter, early 2002, there are probably going to be many layoffs there.
All the bad economic news has made consumers wary. Consumer confidence plunged to its lowest level in 7 years. The index released yesterday dropped to 85.5, much slower than the 95.6 predicted by Wall Street. Falling consumer confidence will undermine consumer spending, says Challenger. And it is consumer spending that drives 2/3 of the economy.
Certainly, the consumer can no longer hold the economy on his or her back like they've done so far through the first 9 months of this year. The government is going to have to step in and pick up the slack.
Today, the president said he was trying to get the government to do just that.
I had breakfast today with the Speaker and Minority Leader, Majority Leader Daschle, and Senator Lott. All 5 of us agreed that we need to work together to get a package, that we've got to put aside political differences and act swiftly and strongly on behalf of the American worker and the American business person. And so my call to Congress is, get to work and get something done. The American people expect us to do just that.
If an economic stimulus package does pass, will it help people like Jean Meyer?
In my mind, theoretically, I think it will help. Personally, in my heart, I don't think it's going to make a job open in the next couple of weeks.
The president says he remains optimistic about the country because of its strong spirit. A spirit that is being tested as the economic storm clouds continue to grow. For Chicago Tonight, I'm Elizabeth Brackett.
And now I'm joined by Terry Savage. Terry is financial columnist for the Chicago Sun-Times and a registered investment advisor. She appears weekly on WMAQ Channel 5's 4:30 p.m. newscast. J.B. Kurish, he is director of the Center for Financial Research and Services at the University of Illinois at Chicago's College of Business Administration, and before that, he was an investment banker. Robert Janetsky, he's president of JanetskyFinancialAdvisors.com. That's an economic and advisory service. And Albert Erlbacher, he's a professor of history at DePaul University. And I welcome you all to Chicago Tonight on a Halloween night. And it's a blue moon tonight, second full moon of the month. Are we going to be scaring people tonight, Terry Savage?
I don't think we're going to be scaring people. I think that people are scared enough already, and probably with, very good reason.
But what do you do? Does one do something different in these times? Have the rules changed in some way? Or are the rules being bent because of the continuing threat of terrorism right now?
Actually, Phil, I don't think so. It always looks scariest just at the bottom when the gloomy news and the headlines come out. Just even leaving the terrorism thing aside, we were in an economic slowdown. We're clearly, I think, well into a recession now. We'll probably see worse headlines about unemployment figures, and more
they come out on Friday.
Yes, and more people having problems. But the fact is, it's not really different. It's no more different now when things look gloomy than it was really different this time at the top of the market when you could buy a tech stock and, quote, get rich overnight. We always think it's different. I mean, I look back to 73, 74, and OPEC had a stranglehold on us. And we said, oh my goodness, it's different for America this time. It wasn't really different,
So you don't think the fact that this country has been militarily attacked in a way that has never happened before has not changed the economic game plan?
I think that it throws a lot of uncertainty into the planning cog, and I think from a business point of view, and I sit in on business planning groups, and from a stock market point of view, and I've talked to market participants, that the world is generally, or the American economy has generally agreed to say, we don't know what's going to happen next with this terrorist thing. So businesses go ahead and plan, and people should make investment decisions as if tomorrow will come and we'll get this under control, because in our history, every other great challenge, whether it was, air raid drills in the 50s, they had the bomb, or the oil embargo, every other challenge we've met and surpassed. And the people who get bogged down in being terrorized by any kind of economic or other uncertainty, just don't move ahead.
Robert Janetsky.
No, I would agree. There are unique aspects about each cycle. A couple of years ago, it was the Asian crisis that was going to spread around the world. The contagion was going to catch everyone up. After that, it was Y2K. We were going to have a collapse. The water wasn't going to work. There's always something unique about each cycle, but the pressures are basically the same. I'm as optimistic now as I ever have been in the past 20 years that our economy is going to be strong longer term. I think there's something very important to look at, and that's the difference between perception and reality. Before September 11th, the perception was that we were safe and secure. The reality was that we weren't. Now, the perception is that we're highly vulnerable. The reality is we are more secure today than we were before then because of all the measures that have been taken since then. And as we apply technology and telecommunications in the future, I believe we're going to become progressively more safe, more secure than we ever have been before.
If that's the case, then why has consumer confidence dropped? Why are people feeling this anxiety if, in fact, we are safer?
There are two very important factors that have really hurt the economy. One, of course, is the terrorist attack. The second is Federal Reserve policy. The Federal Reserve has made a huge mistake. And when I give speeches now, I show the damage done by the Federal Reserve in this particular cycle and compare it with the damage done by the terrorists so far. And
What's
so
the mistake
far,
that the Federal Reserve has made?
The Fed's winning that battle so far. They may not in the future. What the Fed did, and I was on this show, I think, in December, and I pointed out that at that point, my analysis showed that the Fed had the most restrictive monetary policy in 10 years. And with a lag of 6 to 9 months, we should expect the most restrictive economic conditions. Now, the Fed didn't believe it at the time. They were the last ones to recognize that the economy was weakening. And they finally cut interest rates.
Sure,
and lo and
they've cut
behold,
9 times this year.
Yeah, but cutting interest rates, if you cut them too late, does not necessarily stimulate the money supply. I think they finally got money moving positively in May. The Japanese have almost zero interest rates now. You never want to look at an interest rate to judge whether or not you have monetary stimulus or not. We had negative interest rates during the Great Depression during 1 month. It's supposed to be impossible, but we had it. Negative interest rates.
So you're saying,
they
should have cut a lot more faster?
They should have cut much quicker, much sooner, and to a much greater extent. And to some extent, I think they might be making the same mistake today. There are certain indicators that I look at that suggest to me that the Fed is still erring on the side of being a little stingy with respect to money.
J.B. Kirsch, are they being too stingy?
Well, I think that you can look at the fact that perhaps they weren't as expansionary as you would like them to be last year, late last year and early this year. Now, and that would explain perhaps why we have saw this downturn occurring prior to September 11th in the economy. Absolutely. But if you'd also take a look at it, I mean, they have reduced the Fed funds rate by 400 basis points over a 9-month period. They've been very aggressive as of late, and we know that there is a delayed impact of that expansionary monetary policy on hitting the economy. So I agree with you to some degree, but I think we have to say the Fed has done a very good job recently of being aggressive and lowering rates and trying to provide a liquidity into the market. And that this hit on consumer confidence, I think, is hopefully a short-term hit, which has to do with the September 11th event and the subsequent layoffs and other things we're seeing. And I do agree with you both, however, that times hopefully are going to be better in 6 or 7 months. That we do have monetary policy that has been aggressive and will win out over time.
Professor Erlbacher, speaking of time, give us some historical context. What happened during World War II, for example, or during the Vietnam War?
In World War II, it was quite a different situation because you had so much unused industrial capacity, so much unused human capacity in the unemployed and the labor force that it was relatively easy to soak up that capacity in building new plants and reconverting from civilian production.
The unemployment rate before World War II was pretty high, wasn't it?
It was 12 to 15% full-time unemployment.
And right now we had been hovering at about 4%, something like that?
Closer to 5.
Closer to 5, but anyway.
So it's quite different from that. And what you had not only was a high unemployment, but you had people in the state of being unemployed for years and without some of the social and monetary benefits that are placed into the current situation. So it was different in that sense. And I can't comment on the future, but I think one of the things is I would be surprised if in some ways, this thing didn't go in some direction that we don't know of right now.
What do you mean?
Well, just for example, the people who manufacture Cipro, company or companies that manufacture Cipro are in effect a new growth industry, and they are going to take up some slack, I suppose, in other industries.
And there was a report that Eli Lilly in Indianapolis is going to be hiring 5,000 more sales staff to market some of their drugs. Is that the sort of thing you're talking about?
Yes, it's going to be a shift in where people work and the kinds of work, and maybe even in World War II showed the growth of certain areas phenomenally. The West Coast, for example, the Gulf Coast, had tremendous growth in economic activity as compared to, say, the Northeast, where there was some growth, but relatively little.
So there's contraction, but then there's expansion historically.
Always.
Terry, one of the things you've written about and you say repeatedly is that over a 20-year period, the stock market always goes up. You still feel that way?
Yeah, I mean, Phil, it's just a fact. You look at a long-term chart of the stock market, and all the times that I lived through and others before me lived through that looked so scary, look like little blips. If you believe in America, then, and you have that long-term horizon, and you're diversified, all those caveats, and I think there's no reason for those who are working today and still employed not to have that time horizon, then of course I advocate continuing to invest on a regular basis.
What if somebody feels like making some adjustments? They just want to calibrate a little bit, other options that they have right now that make sense?
Well, tomorrow's column, I gave you a preview of that. It'll be in the Sun-Times in the morning. You know, let me just start like this. Let's draw a line down the middle of the page, and there's good news on one side and a little scary news on the other. Here's the good news. The Federal Reserve is cutting interest rates. They're pumping money into the economy. Energy prices are lower. That puts more money in your pocket, and there's a tax cut. That's all very good news for the economy and eventually the markets. On the other side, there's an undeniable slowdown, and people are getting laid off, and some people's friends are getting laid off, and there are a lot of people buried in credit card debt. And that's a real problem for other people. And sure, we'll work our way out of it. So when you say to me, what do? You sit down with that piece of paper and draw the pluses and minuses in your own financial life. And you say, look, I'm working, my job's secure, I'm going to keep putting money in that 401k plan. Or you say, one of us might get laid off. I said this, 3 months ago when I was here with you. This is the time to pay down that credit card debt. Not because the end of the world is coming, because you need to ride it out. I'm very hedged now, in my opinion, of just how long it will take for the stock market to recover. We've bounced back to the September levels. We've come back. It may test those old lows, but that's real short-term stuff. If you're young and you're working, you got to keep betting on the stock market. It's never worked to bet against it.
People in their 50s and 60s, though, any calibration that they should do?
50s and 60s people are going to live another 30 years, we all hope. And if you're still working and you still have the opportunity to buy stocks in your retirement plan, I think that's a great idea. But again, last 2 years ago...
Though, if I can interrupt. In your column for tomorrow, which you were nice enough to share with us, you talk about how one of the continuing safe areas might be residential real estate.
This is a very interesting situation, particularly in Chicago. A lot of speculation. If you've been downtown lately driving up Ohio Street, there are a lot of condos going up, and a lot of people bought those because they thought it was even better than stocks. Now, a lot of people are scared out of the stock market, and they say, you know what, if I put money into a house, at least it's not going to disappear overnight. That's very bullish for the housing market. And if you find the place where you want to live for a while, you're getting a very low mortgage rate. It could be the best deal of a lifetime. So obviously this is the time to buy that home. But if you're a speculator, you might get stuck with a condo you don't want to live in, and you could get burned in housing as well as in the stock market.
And let's go back to the stock market. Bob Janeski.
Yeah, let me try and redirect this to the short term, because that analysis that I had back in December, that money was as restrictive as it had been in more than 10 years, turned out in effect to be pretty accurate, at least in terms of the subsequent weakness in the economy. In May of this year, the lower interest rates finally, according to my analysis, started to kick some money in. The usual lead time with the stock market is 3 to 6 months. So we should have expected somewhere between August and October we would start to see a turnaround in the stock market in a positive direction. And 6 to 9 months would take us to the end of the year, to the spring of next year, before we start to see the pickup in the economy. That would have been the normal case without the terrorist attack. And your question at the beginning was, well, what the heck did the terrorist attack do? And obviously, what it did was create tremendous additional risk associated with any business decisions because of the unknowns. And the question is, how do you deal with that risk?
The market hates unpredictability.
Well, yeah, but how do you deal with the additional risk? And the obvious thing you want to do is you want to get the risk down. And you want to get it down by convincing people that they can be more secure than before. The problem is, just as you cannot prove a negative, you cannot prove to people that you will not have a terrorist attack tomorrow or next week or next month or next year. So the risk premium will only come down very gradually. What other options are there? The other option is you increase the rewards to compensate for the risk. And that's what government policies should be doing now. And the best way to increase rewards is to cut capital gains taxes and cut them significantly. What people will then do is they'll look at, yes, there are additional risks here. But wow, if I go ahead with this business activity, I've got huge additional rewards because I don't have to pay taxes or I don't have to pay as much.
Real quick on the capital gains business, Mr.
Well, the
Kirsch.
capital gains, I'm in favor of less taxes. But I don't see in the short run that that reduction in the capital gains tax or an elimination is really going to help us in the short run.
It helps us immediately. The day it's done, it helps us.
I don't think that there are people that are not engaging in investment activities because, quite honestly, it's very inexpensive to get money these days. Interest rates are very low. I don't necessarily agree with the premise that a reduction or removal of the capital gains tax will all of a sudden have people make investments they wouldn't have done otherwise.
The professor wants to get
These
into
kinds
this.
of questions would not have come up in 1942 because the main supplier of capital for investment was the government, not the private sector. So there was this hesitancy. Government had to, in a sense, step in and build, in many cases, build the plants and lease them to manufacturers to operate. And there wasn't a widespread ownership of stock at the time that there is today, either by individuals or through mutual funds that there is. So that's quite a different situation. And there was a desire to reduce consumption. Now we're looking for ways to increase consumption by our way back.
So what lessons are there from World War II or from Vietnam that might come to bear now?
From World War II, I don't think there are any direct lessons to this situation because it was so different in the sense that the government had to supply such a large percentage of the capital to get the war machinery going.
On the issue of taxes, though, there's a disagreement here about whether or not a cut in the capital gains tax is the way to go.
No, there wasn't. I don't know. I won't comment on that.
But
I think in World War II there were raises, huge raises in income and income taxes and corporation taxes. In Vietnam, some historians feel that Johnson held back too long asking for a tax increase, and that had something, that was one of the factors that may have led to the wave of inflation that characterized the 70s and into the early 80s.
Is that a risk now?
Can I say something about taxes? Because I believe that there's a great deal of misunderstanding on the part of a lot of people in terms of what creates economic stimulus. We hear a lot of talk from the administration, the Congress, and I'm sorry to say even some economists, suggesting that government spending is going to stimulate the economy or that tax rebates are going to stimulate the economy. That is absolutely false. Unless you believe that money for the rebates or the spending is coming from the good fairy, it is not going to stimulate. And the reason it's not going to stimulate is because in order to give that money to people, the government has to take it out of the private productive economy. So it takes it out of some pockets, which may be using it very efficiently, puts it into other pockets. The net effect is actually to repress the economy. Now, that doesn't mean that we don't necessarily want to increase spending for the unemployed or whatever, but we shouldn't kid ourselves into thinking this is stimulus.
A quick response from J.B. Kirsch.
Well, again, I agree and support less taxes, okay? But I don't think as we are engaged today in the discussion about what we need to address, what is a psyche situation for consumers, which is dangerous, as indicated by the consumer confidence number, that if we look at the reality of Washington, D.C. right now, there's just no way a capital gains tax is going to happen. And I think one of the risks right now, among several risks.
I agree, the odds are against it. That's not the issue. The issue is, does it make sense? If it makes sense, then we ought to support it.
It doesn't make sense because it's not reality right now in my mind. In that,
you mean a political reality?
Yeah. In that, I think one of the things among the things that would be very dangerous for us would be is if consumers continue to believe, or Americans continue to believe, that we're not on top of controlling terrorist acts at home. If they believe that the situation in Afghanistan wasn't winding in a positive way, we'd have a negative risk if they really felt that Congress was in a gridlock and they weren't moving forward. We'd have risk if the stock market were to collapse.
What should you do about that increased risk then? What would your advice be because of all of that increased risk? Let's say everything is going wrong and we've got a huge risk. How do you get people to make decisions amid that risk? What do you do? You give them a rebate and take money from other people?
Not necessarily saying that. But let me point out one other thing that makes me concerned about where this risk may be even going higher in terms of ratcheting up how consumers feel.
What do you do about it?
Just one second. I think we're getting what I'm calling a piling on effect here. I think we're having companies who are going to do a lot of things like dismiss people, cut factory lines, close a business operation here or there, because they're looking at their fourth quarter and their numbers aren't going to be good. And we know that oftentimes a company may look at their quarters and say, to try to make things look better, I'm going to do a little accounting manipulation. I don't mean manipulation, a negative thing, but to do some actions to help.
I agree with all that, and let's say it gets even worse in the first quarter. So what do you do?
Things are bad right now, so I think we're going to see a lot of just taking a lot of losses, bringing a lot of things in right now, which is just
what
going
to continue. About it?
Hold on, and attributing it to 9/11.
Right, because generally the economy and people are going to say, oh, it's because of 9/11.
Okay, Terry, real quickly, there have been so many people laid off. Some nuts and bolts advice for somebody who loses their job?
Oh, that's it. You lose your job, the first thing you think about is your health insurance, because you want to make sure you have a COBRA policy to carry you over. Then that'll last 18 months. The next thing you think about is rolling over your 401k plan. Don't touch it. Don't pay the penalties. That's the last thing you should do. Roll it over into an IRA. Have the money transferred directly. Take a look at your company's severance policy. If they're doing a wave of layoffs, you're probably not going to get any better deal. But don't sign anything if you think you've been discriminated against unjustly. And then start thinking about what you can do. And it may not, you know what,
Terry,
this may be a great opportunity.
We'll have to continue as the credits are rolling. In the meantime, I'd like to thank all my guests tonight, including Terry Savage, J.B. Kurish, Albert Erlbacher, and Robert Janetsky. And as always, my thanks to you for watching at home. Tomorrow night in this program, a look at that literary controversy between an author and talk show host, Oprah Winfrey. What happens when the high literary tradition meets the marketplace and one of its best-known television personalities? Can an author still be taken seriously if he or she gets Oprah's seal of approval? That's tomorrow night at 7. And if you have a question you'd like to ask, you can send it to us at networkchicago.com. Again, that's networkchicago.com. I'm Phil Ponce. Good night, and hope to see you next time. Professor, you wanted to say something?
Well, it's all different from World War II because there was a need to stimulate the economy, and the only entity that had the wherewithal to do the stimulus was the federal government by printing up the money and high taxes because they wanted to reduce consumer demand in a market.
This evening's uninterrupted presentation of Chicago Tonight is made possible in part by LaSalle Bank.
Now this allows me to download current stock quotes from the net and track the PEs on this chart here. Well, okay, that's nothing new. But you know how every time you make a trade on the net, you have to reconfigure your
Interesting. She put a Louis XIV chair next to a garage sale sofa. That's a look.
I can make a pie chart.
Pie. Now that sounds good.
Exclusively for my 401k.
If high finance just isn't your thing, that's okay. It's ours. LaSalle, the bank that works.